What's up, everybody? Michael and Coco here. We haven't shown our face for quite some time. We wanted to come on and say hi before we get into the daily stock market brief, the show that I do Monday through Friday, 5 days a week. Today's date is November 4th. We use technical analysis to really help us get a good idea as to where the stock market might be headed next. In today's episode, we're going to be looking at the indices, indicators, commodities, yields, and the dollar. Let's get into today's episode. All right, welcome back. If it's your first time here, by the way, thank you for coming to the channel. I really appreciate the support from everyone that continues to show up on these videos. I do have a website out now, and I have a new section called the Market Dashboard or Market Updates or something like that. I just started it, but I'll be posting that on Twitter and Instagram and so forth. Every time that I have maybe a market chart that updates intraday, that's where it's going to be posted, just so you can get a good idea, as to what I'm thinking, in the middle of the day. So take a look at that. It'll be linked in the description or in the comments. I haven't figured that out yet, but let's start. Oh my gosh, I'm tripping on my words here. Let's start off looking at the weekly S&P 500. First off, what I want to point out, clearly the week is succeeding quite well so far, up 5.31%. We're running into this trend line we've been kind of keeping an eye on. It recaptured the 5 EMA. The 5 EMA is that EMA that, once it gets too overextended from it, like it did the previous week, you typically get snapbacks to it. It's just frequently tagged. And now we're not only above it, we then kind of got rejected, and we're sitting right around this trend line. Notice the trend line above us. We'll talk about that a little bit more on the closer time frames, like here on the daily. Really what I want to point out here, I'm not going to be spending too much time on these charts. Look how overextended from the 5 EMA we are, and look at the gaps on the way up. Last time that happened was here, and then we came down to fill the gaps. The time before that was right here when we started just squeezing up, and then guess what happened? We filled all the gaps. So overall, let's look at this trend line, and this trend line, we're coiled within it. In order for the bulls to really take charge, we need to get above this and hold it, and even get above that gap. For the bears to really take charge, well, we need to get below this lower trend line. It's really that simple as of right now. Okay, here's the NDX, NASDAQ 100. Just a monster gap up. Holy moly, just a vertical move all around. MACD's crossing over, could be potentially bullish. Still probably has some room to go, as you can see. It's possible. 12,000 looks like it get hung up a little bit about there. Potentially start moving up higher, but we have previous resistance at 12,000 from this trend line, then we have 12,100, and then we have this gap. So a lot of work for the bulls to do, but keep in mind, really overextended from the 5 EMA too on the daily time frame. And if you just look at each candle, every time that it gets overextended like it did here, boom, it snaps back. Closed right here, boom, it snapped back. Got really overextended, boom, it snapped back. So it's something to take note of. Doesn't necessarily mean that it can't go higher or further, but like say if it does come up into this range at this top and we gap up, tomorrow and then comes here, chances are that's when everything's going to look way, way overextended, similar to how it happened here and right over here, and then we got those snapbacks. So everything's kind of lining up for a potential major resistance up ahead for potentially a swing short type trade, but we'll keep an eye on it. Here's the Dow Jones. The Dow Jones, what I wanted to point out here was these obviously 3 big gaps extended from the 5 EMA, just like the other ones, got rejected at this horizontal line. Clearly it acted as resistance before, but also to add a layer onto that. That was where a previous gap was. I converted it to white because that gap has been filled and then got rejected. Sometimes when gaps are filled like this, they act as a level of resistance. Long upper wick, okay? It was above the 20 and the 50 period moving average. Long upper wick, the bears really stepped in there, creating a lot of opportunity. I know that a couple people got in short right around these levels and really paid off big for them. Here is the KBW Regional Bank Index, and we'll talk a little bit more just to follow up on yesterday's video. We pointed out this horizontal line as support and this big run up. And I was kind of saying, I just don't see how it could, continue to move up. The financials seem pretty squeezed, but yet yields have been rising, which is good for the banks because they lend out short term and they borrow short term and they lend out long term. So we got into this area right here of resistance, and come to our surprise, what happens? Well, we get crushed on the day, 7.41% down. We have this inverse head and shoulders. That was the neckline. Couldn't break it, but still kind of within this pattern, so I'm still holding it there as of right now. And we'll talk about the yields here in just a moment, but let's go ahead and hop into some indicators. The first one I want to point out is the VIX. This is on the 2-hour time frame. Keep in mind, that, yes, it was a pretty gnarly day for the VIX. It was just this monster move to the downside. Got very, very overextended. A little bit here to the, almost overextended on the RSI, but it's kind of floating around there. Now, something interesting that I want to point out here is I wanted to show that there's still a lot of gaps below us on this time frame, which could potentially mean we still have room to go higher on the S&P 500. So the VIX does typically fill a lot of gaps, and there's even one farther below us that's been bugging me for quite some time, but I'm not going to get into that. What I'm trying to say here is it's very possible that we still could get continuation to the upside for the S&P 500 and come in to fill some of these gaps that we left on the way up from back here at the end of September. So that's something to keep kind of in mind here. Also, though, we also now are creating more gaps just above us. VIX is now right around 29.57, so, you know, welcome back over here down below 30. It was hanging out above there for quite some time, and that's when really all kinds of crazy volatility picked up. So it's something to just monitor and keep an eye on, something to note. It's a lot of our indicators that we're going to go over today. There's no clear direction, and I want to make sure that I point that home. Is sometimes we have very, very clear direction on our charts, and right now we, you know, overall it's showing that we can potentially move higher, but it's also showing, hey, we're getting kind of overextended. We can move a little bit lower. Here's the BP NDX. We were overextended. We pointed that out, said we had room to go. What do you know? The NDX moved higher, and now we're printing right around 55. And then the RSI is at 46. So, like I said, we have room to potentially still move higher. Doesn't mean that we will move higher, but it means that we still have the possibility and the room to move higher. The last time it was overextended was down here. Okay, it created a bullish divergence, and then we got overextended to the upside. But notice just when it gets overextended, you know, it moves back up to the top and kind of ping-pongs around. So, like I said, have room to go still. Here's the CPC, smooth over a 10-period moving average. I just want to call out that when it crosses above the red, that's typically a sell signal, and we've been monitoring it as just a sell signal, and it's been working. So it crossed above, boom, we fell to the downside. It doesn't tell you how far you'll go, but clearly it worked out for us. It gave us that warning. When it crosses above the green line, that's signaling, hey, we could potentially be buying in here shortly. When it crosses back below, that's technically, I guess, a buy signal. You can use it as that. I don't get too excited about the buy signals on this specific indicator. I like it more for the sell signals. But, you know, I just figured I'd point this out. We crossed above 0.95, just so you know, when last time we did that was over here, right before the February to March crash. And clearly it stayed up in this range for quite some time. When it gets to these levels, you can see that, hey, you know, people are very, very bearish, which typically means for a contrarian, all the bearish trades have been placed. It's time to get bullish. So we'll be keeping an eye on that. This one is the NDXA 200R. This basically means, you know, what percent of the NASDAQ 100 stocks are above the 200-period moving average. And right now, 86% of the stocks in the NASDAQ 100 are above the 200-period moving average. Okay, so that's the pointer right there, 0.86. Why am I showing you this? Well, when it gets this high, it doesn't mean that it can't stay up here or trend up here, but typically when it gets this frothy, it means that we might see some kind of pullbacks. And I just wanted to point out a couple of times where it happened here in 2018, just late January. It got over to this level, and you could see down here we crossed below, and you know, it's hard to see how big of a move that was, but from 7,000 down to just above 6,000, it's a pretty big move. Right here, it did it multiple times, boom, boom, boom. That was leading up to the March crash. Right here, it's hard to see. In June, we saw that big spike to the downside. Keep in mind, we still ended up going higher, though. So this is not an end-all, be-all. But we did cross over here. That is when I actually warned it, was here in mid-October. When we got that really high spike, I was like, okay, everything's overextended. We were printing above 90, for goodness sake, over here. And then we saw that big pull down to the downside. Now we're at 86. We're coming into this trend line. Can we still move higher? Absolutely, but things sometimes get too frothy, and if it does reach back up to these high levels, chances are we can run out of steam and then see a pullback. So is it the best time to go long? Maybe not. Probably not. I mean, maybe there's certain setups, certain stocks that we can look at, but as of right now, looking at the NASDAQ 100, yeah, it's getting kind of frothy. Next thing I want to point out is the CPCE. This is more of a sentiment indicator, but this is on the monthly time frame. I pointed this out quite some time ago, and this goes back to 2004. Notice this low line here at 0.45. When it hits here, this is basically saying, hey, the market is entirely bullish. So if you're using this as a contrarian indicator, what you can take from this is, hey, when it gets way, way, way bullish, means most of the trades have been placed for the bull side. It's likely to see a reversal take place. That doesn't mean it's going to happen or it can't go lower, but it does have historic kind of price point and levels. And what I marked out was when the monthly CPCE reaches 0.45, that's an extreme level to the downside. The next 5 months become quite volatile with swings as big as 20%. This one here, when it did it, -7, -20, -17. Right now, I did the calculation from the September high to just this last month low, or the September low or October low, I can't remember. It's about a 10 to 11% swing so far. And as you already know, volatility has been quite insane back and forth. What's interesting here is we touched here in late August or September, I can't remember exactly, but now we just came back after a big sharp move to the upside. We're just now tapping it again, which is quite interesting because I haven't seen that actually really happen lately. So what is that telling us? It means that the market is extremely bullish. Why are they so bullish right now? I don't know yet. It's too hard for me to tell. Commodities. Guess what? Gold got rejected by the upper trend line. Why do we say waiting for confirmation is important? Simply for this reason. If you don't believe me, watch yesterday's market brief video when I said we need to wait for confirmation. Now we're getting kind of rejected right here. It'd be nice, like I said, I'd pick up the more physical asset down here in this range, or even by this 200 period moving average and previous support. I would really like for that to take place, but you know, we'll see what happens. Silver is a very similar kind of boring story, to be quite honest. It's, yeah, we had the hammer candle, bounced up a little bit, still below the 50 period and still below this horizontal line of resistance. We'll monitor it closely. We'll see what takes place. Bitcoin, on the other hand, has been the shining star of all of this. On the weekly time frame here, I wanted to point this out because one of my subscribers said, hey, you should probably look at a longer time frame, and I wanted to point that out, that I have been. And you know, we broke out of this symmetrical triangle, we back tested, now we're really rocking higher. Wanted to point out though that the weekly RSI, it's oversold. Okay, now when overbought, it's getting frothy at 74.2. Doesn't mean that we can't stay there for a while. It's happened here, then we kind of moved down. It's happened here multiple times, but you know, boom, 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 boom. We had pullbacks, but man, that thing just kept on running. So yeah, getting frothy might not be the best time to go long, but you know, what do I know? Let me look at the daily time frame. I've been saying that this pattern here is just confusing me, to say the least. It looks like a bull channel, but almost like a broadening wedge. I don't like it because it seems like it starts off tight here and then just gets more and more volatile while the price is still very frothy up here. Negative divergence, but you know, hey, you know, the bulls keep pressing it up higher. It's going to be interesting to see how this plays out. I personally would like to see a pullback, and then I'd consider, all right, maybe I'll get into this a little bit. I'd say a pullback to 12,000, maybe just a little bit above that, would make sense to me. But just hopping in right now on this hanging man candle at the top of this trend line with the negative divergence, and the MACD isn't doing much, but the histogram is kind of just dying off. Doesn't seem like the best, you know, entry point from my point of view, but I've been wrong plenty of times, so maybe it's the greatest entry. But from a technical standpoint, if I was looking at any other chart, I'd be like, no, I'm not going to enter right there. Let's look at the dollar. The dollar keeps playing games with us. We broke out, then the dollar looked really strong today, and then it got rejected back from that 94 line. So what do we got going on? I'm looking at two main levels. The bulls need to break above 95 and confirm it, or the bears need to break below 92. Till then, we're not going to really see any big move because we're just trading within this channel. So talk about a snore fest for the dollar. Let's look at yields. Yield got crushed. I'm surprised this didn't make more news, but we called this out yesterday. We were moving into an area of resistance. This is June resistance at about 0.9, just completely obliterated. The 10-year earlier in the day was like down 14%, and it might be, I don't have that number in front of me, but down 6.63% on the 30-year yield. Now, we said when rates increase, that's good for banks. When they go down, that's bad for banks. Yields went down. What happened to the banks? The regional banks got schmammered. And we are looking over here. This chart down here is the spread. And keep in mind, it's still part of this trend line, so we haven't broke it. But if the spread starts getting tighter and tighter, obviously the only way that can happen is if the 30 and the 10-year start moving lower and lower. Going to be interesting to see how all of this plays out. But I would say, you know, hold on to your pants in the equities markets. If we start seeing these yields get really crushed, typically a spread that is steepening like this means that, you know, we're forecasting higher inflation and economic growth. Now, I showed some big picture charts, so if you haven't seen that video, I would recommend going to look at that. Back in like 98, when we got inverted slightly, looked very similar to how we got inverted here in 2019. But then the market took this little breath, made an all-time new high, but the yields then got inverted again, steeper, just a deeper decline, I should say. And then that's when the 2000 bubble burst. So not to say that that's what's going to happen here, but nonetheless, you know, it's something that we have to take note of, something we need to pay attention to here, because the bond market is the smart market. It's a lot of smart money, big time investors. They look at all the economic data. They put in all of their information. They make the big moves, and we can just read the chart to really help determine what their perception actually is. Let's get into the conclusion now. I'm trying to keep this video, like I said, short. The conclusion is simply this: a lot of market uncertainty. Not much has changed from my point of view. I've been saying that when the market gets overextended how it was to the downside, it was likely to see a move. I still believe that we still have some legs to potentially move higher. When I look at this chart, I just want to point out the major levels here. This move to the upside, I missed this move, but I'm okay with missing this move because we know what happens with all these type of gaps and when we get overextended from the 5 EMA. Now, what are we going to consider? What am I considering? Well, we're still trading in with this channel from September to October. So we're still within this symmetrical triangle, and we could ping pong back and forth for quite some time. So as I see it right now, not much is going on in either direction. The bulls need a break above 35, above this trend line, and even above this all-time high. And then the bears need to see a breakdown to really kind of get a good sense as to what might create more momentum in the market. That's all I got for you on today's stock market brief, everybody. Thank you for watching. Thank you for tuning in. I really appreciate it. See ya.